Okay. All right. That can be cool. All right. Good evening, everyone. You'll notice a new location and a new face today. I'm actually out in town here in Singapore, and I've got Nick van Broekhoven, one of our insight providers, sitting in the same room with me today. So hooray to things opening up a little bit more in Singapore. So as always, I take the first few seconds to run over our disclaimer. So the weekly forum is strictly for Smartkarma subscribers. It's purely for informational purposes. It is not targeted investment advice. It is the opinion of our insight providers, not of Smartkarma. And importantly, Chatham House rule applies. So please do not share any of this on social media or any other public forum without express permission. Now, while we're waiting for attendees to stream in, I'll just briefly recap some of the things we discussed in the last few sessions. So last week, we took a look at Oriental Watch, and we examined it very much from the lens of a value investor. And we also took a look at an impending catalyst for the company, which is the next results. Then we sort of swerved course and we looked at a beaten down, very high growth China EV company, which is Xiaopeng Motors in the US. And we looked at how Xiaopeng might be probably the best EV story in China, but not necessarily recognized by the market yet. And then lastly, we took a look at a revival of capital markets in Philippines and a clever way to position through the exchange, the listed stock exchange. And then the week prior to that, we did a bit of a recap. We looked at Straits trading, which has been an idea since Q3, Q4 last year. And we took a look at recent developments. Then we looked at Pacific Textiles, which is a potential M&A candidate listed in Hong Kong. And with both of these, we looked at how things stand today, 3 to 4 months in since we first looked at these. We examined this emerging new theme around Internet of Things. We've noticed 2 recent listings in this space, and there's plenty more in the pipeline from what we look at. And then lastly, we took a look at how funds are currently positioned in the energy sector. And this is sort of an important one because we've been talking about Kunlun Energy as one of the key ideas, which fits in with this thematic as well. So like this, every week, we try and break the forum into 3 sections. We look at an interesting small and mid cap, and we try and always reveal a different perspective or way of looking at it. Then we look at a large cap, and when we're looking at large caps, we're always focused on what's mean variant. What is the market missing? And then we always explore a theme. So with that in mind, in today's forum, we're looking at 3 things. First off, we will be kicking off with a small cap energy company that's trading on about 1 times PE, and Nick will be sharing that with us. Then we will be looking at a $200 billion market cap company called Pinduoduo, PDD. This is listed in the US. It's a Chinese company, and we will talk about a potential disruption to the growth thesis. And then lastly, we will examine positioning around telcos in emerging markets. Let's kick off things. Cool. So the energy company, or specifically the oil company we're looking at, is called REX International. It's listed here in Singapore on the SGX. It trades about $4 million a day. Its market cap is about roughly around 230, 240 million Sing dollars. And I've just put down a few key bullet points, but Nick, over to you.
Yeah, so basically Rex has been listed since July 2013, listed at 50 cents. Then quickly afterwards, it went up to close to 90 cents on a lot of excitement as the company listed as a technology play. It was a virtual drilling technology. So they were have this technology for seismic analysis of data, and they were going to oil companies to give them this technology and to help them better find oil fields in the future. So that was very exciting. When they listed 2013, oil price was over $100. And then the subsequent 3 years, the oil price crashed to $25 in 2016. So as you can see, the stock completely cratered together with that, even though the company was never really going into the oil production field. So at the time of the IPO, they also had the aim to develop some minority assets in Norway and then in Oman in terms of oil field, but there was more to prove their technology. But now over the years, the focus has shifted a bit, and they are now actually an oil producing company in Oman. And so last August, they got a certificate, to produce for 20 years in Oman with the Oman government as their partner. And now the oil is, really starting to gush out. And of course, during the pandemic last year, there was a bit of a lull because the oil price dropped so low that it was not very economical, and they had to sell barrels at break even or a loss. But now with the oil price at $60, $65, actually the economics start to work in their favor again. And as they've publicly announced over the last few weeks, they are going to be producing about 30,000 barrels a day, gross barrels, because there's water in there, so 20,000 barrels a day in net barrels, so real oil. That oil will, really start to accumulate. So it will become very, very profitable this first half, and that will show in the results in July, August when they publish their first half results, and then particularly for the second half as well. And so the field that they're producing now in Oman is called the Yumna field, and this is a tiny part of their acreage that they have in Block 50 in Oman. So this is all also explained in my July piece from last year and in my piece from 7 days ago. Both are published in Smartkarma, so you can read more about the history, etc. So basically, this is a play. It's kind of forgotten. There's a company that trades in Norway called Tethys Oil that is also active in Oman. They're onshore Oman, and they have less production than Rex, but they trade at almost 2 times the market cap. So I think over time, this company will start to, cash will start to gush in, which is really now happening. The market is slow to recognize this. And then there's a lot of optionality here. The company, just yesterday on the SGX, on a company announcement, asked to reauthorize the buyback. Why are they doing that? They can buy up to 10% of the stock. The reason is that they also have assets where they're minority shareholder in Norway. And there they have in the past divested these assets at big premiums. So one asset that they now could potentially monetize is the Shrek oil discovery. They are in there with Equinox and a few other big oil companies. And they invested $5 million 2 years ago. And according to my estimates, they could get 25 million US dollars. So again, the market cap here is less than 250 billion Sing dollars. So this really, could be a big cash coming back to them. And while it's not sure, that could also mean that they could, use that cash to buy back a significant amount of their own stock. Then in Oman, they continue to drill because the Yamna field is flowing. So they have 30,000 barrels gross, $20,000 net. So that will continue to come in. You can go to my piece from 7 days ago, look at the math. It's trading about 1 time probably pre-tax earnings, which is, hard to believe. So we will see if they can deliver that. But according to my math, with 310 days of operations going, so not the full year because of maintenance, etc. And then at a $55 oil price, you get to some pretty silly numbers compared to where the market cap is now. But there is still a tax split with Oman government, which it still has to be adjusted. But still, the numbers, is it 1 time the earnings? Is it 1.5? Is it 1.7? I mean, it's more back of the envelope to put your attention there that this is probably very cheap. Then the long-term game is that the big owners of the company own 46%, the Lindgren brothers, and the chairman, Dan Brostrom, and they are in their late 70s. And I think at some point they will want to monetize their stake. And they outside of the Yumna field are now also doing exploration. So they're currently exploring in the Pluto well, which is one of the exploration wells they're doing. And the big upside is in Block 50 in 2013, it was estimated by Aker Geophysics that there's 4 billion barrels risked. So of course they have to prove that that's there. But if they find 4 billion barrels, I mean, this will be a game changer, and Total or ENI, which are their neighbors, could become extremely interested in this company. So I don't think there's a lot of downside here. I think there's a lot of optionality. There's, the owners are getting older, major owners. They will, I think, will want to exit. The company's become much more active trying to tell their story. They've kind of commissioned this report as well by SP Angel, which had a lot of extremely detailed information about the company. which is impossible to gather for anyone outside. So it kind of, the company's kind of trying to tell investors like, look, they're probably significantly undervalued. And I think that's true. And so I think this is a good, risk reward case that for people, they're not averse to owning some oil and gas exposure can have a look at Rex.
Mm-hmm. Thanks, Nick. Again, this sort of fits in with what we discussed last week, which is just how underexposed active investors are towards energy as a sector right now, at least compared to historical levels, and also compared to where oil price is today. One question, Nick, have you had a chance to meet with management?
Yeah, I've met with the chairman a few times. He's based here in Singapore. The other major holders are based in Sweden, so I've not met them. And obviously now there's no chance to. Has been no AGM, not last year, this year. Well, I mean a virtual one, but not one where you can physically meet them. So no, I've not met the other.
Right. And would it be fair to say that the biggest risk, if at all, is just maybe oil prices coming down?
Yeah, of course. This is a commodity play. I mean, if oil price goes back to $30, $25, $30, this is not really economical. The risk here, and that's why it's probably cheap, is that the Yamuna field they have now is a marginal field. They probably can extract all the oil there that they know today, 13, 14 million barrels in total reserves. Probably in 2 years, 2.5 years, that field is done. So unless they can extend that field, but still the cash is going to be real. So unless they blow all the cash, it will still come into the company. It should probably means you'll get all the cash back in the company. The company has no debt, so I don't think there's any risk there. So I kind of like the risk reward setup here.
Understood. And this is trading about $3 to $4 million a day, which is very respectable for a small cap on the SGX.
Yeah, there's a lot of churn here, so there's a lot of people passing it from one side to another, so that people have raised skepticism about that. But I from everything I can tell, I think it's it's a legitimate company. I think they could have some things differently in the past, maybe overhyped their technology a bit. Almost 10 years ago now that they listed, but. I think now where things are, and of course the upside to this is that if the oil price goes much higher, then it will become even more interesting.
Perfect. Well, thank you. Just a reminder to attendees, you can ask questions at any time using the Q&A button, and certainly at the end as well. Okay, with that, we'll sort of move on. Thanks, Nick. Thanks again. We'll take a quick look at Pinduoduo now. I mean, this is the other end of town in terms of size. Was nearly a $200 billion market cap company a few weeks ago. It's corrected a little bit since. It trades over $1 billion a day. So, very interesting. Also, this is probably the fastest growing listed Chinese company we've ever seen. They went from listing to $200 billion in less than 5 years, and a very interesting, very young entrepreneur behind the company. So I think the sort of key points we want to talk about today is typically sometimes when stocks go from great to good, there is a big derating. And the issue with Pinduoduo is that it might be moving very rapidly from great to good. And we just want to present that thesis today for discussion. So yes, this is a company that has demonstrated hyper growth, but when you look at any valuation multiples, let's say just price to sales, this is 3 times Alibaba's price to sales multiple. But it's not a profitable company, whereas Baba actually makes very decent profit margin. Secondly, the growth is already slowing down. In 2019, this company was growing about 130% year on year. By 2020, that revenue growth dropped to 62%. And the analysis that Mitchell Kim has done on the platforms suggests that typically when you see e-commerce businesses, when their growth rate drops just below 100%, it actually starts falling very, very rapidly thereafter. Some of this is mathematics, but some of this is also indicative of shifting consumer behavior patterns. The third thing is, if you look at things on a quarterly basis and you look at gross merchandise value. So gross merchandise value, or GMV, is basically the dollar value of everything that they sell. This has continued to decelerate now for a few quarters, and it decelerated further in the fourth quarter. And I think, there are some basic growth rates that are required by this company in order to maintain a certain overall revenue growth line, and it's just not being able to maintain that. But I think perhaps the other really worrying trend for us is, it's been several years since this stock got listed, but there is no path to profitability. Conversely, gross margins are coming under pressure, and operating margins losses continue to widen. So, typically by this time and by this scale, you need to see some modicum of profitability starting to come through. That is sadly missing. And then some people have assumed, rightly or wrongly, we think probably wrongly, that while Alibaba and Tencent have this overhang of regulatory risk and anti-monopoly measures, Pinduoduo is immune. However, Mitchell is pointing out that actually there is a different kind of regulatory risk that Pinduoduo is exposed to. They actually use very, very aggressive discounting and marketing and promotional activity. And some of this can lead to AML type activity as well. So there is a risk that there could be a potential crackdown of this sort. I can recall from sort of 10 years ago, the Chinese department stores, for example, there was a similar sort of crackdown on the way they were doing certain promotional activity. And I think lastly, just a few days ago on the 17th of March, this charismatic founder, Colin Huang, very unexpectedly stepped down from being sort of chairman and director. He has, however, pledged to extend his lockup in the company. So he's not sort of, selling his shares, but he has sort of quite literally walked away from operational activity in the company, which is a bit of a question mark. He's given a fairly sort of creative reason. He wants to focus on personal growth and look at more areas. He said the company has gone from being a teenager to an adult very, very quickly. I mean, interesting language. I think that departure letter is quite interesting in itself, but given some of these other concerns, this is probably the type of name that, one would rather be a customer of than a shareholder of at the moment. So that's the thesis. And the third thing on today's segment, we will take a look at how active investors in emerging markets are positioned in telcos. You'll recall that, maybe once a month we pause and we look at positioning, because this gives us a lot of contrarian ideas, value ideas, differentiated ideas versus where market is. If you'll recall, in Q4, we looked at positioning in banks, and financials became sort of a core thesis for us, and we looked at some good financials ideas. Then we looked at positioning in energy, and we've spoken about Kunlun. Today we're speaking about Rex, and now we're looking at telcos, where the sector is just really, really beaten down. So these charts are a little bit slower, but if you look at this bottom right-hand side chart, this shows the percentage of funds that now own shares in telco stocks. And this was already very beaten down, but in the last couple of months, it's taken a really big dive down. So today, the ownership in telcos is 65%. So only 65% of all active fund managers out there own even one single stock in a telco. So that's very, very low. It's actually the lowest amongst all sectors. Secondly, the average fund weight, which is this bottom left chart in turquoise blue, is now, used to be about 12% and is now, less than 2%. So not only do few people own it, but what they own is extremely small as well. So this sector, if you go back 10, 15 years ago, telcos was like the sector that everybody used to play growth in emerging markets, and it's completely fallen out of favor. So a little bit closer. So as I was saying, average fund weighting is now 1.7%, literally the lowest level on record, and only 65% of funds have exposure. Now, who sold? Basically, any growth investor has sold. So growth investors have basically decided that telcos don't offer any growth, and value and yield funds still own these stocks, but in much lesser size than before. Now, amongst all the emerging market telcos, the biggest ownership is still in China Mobile. This is 941 Hong Kong. And what's very interesting is recently this stock and the other Chinese telcos, they got kicked out of the US indices. This was done in the last few days of the Trump era, where some of these Chinese companies were sort of forced out, and it led to a big sell-off. But the primary listing of the company is still Hong Kong. And actually, very recently, there have been some conjecture that the Chinese telcos are also considering a dual listing on the A-share onshore Shanghai market, where multiples are a lot higher. But people haven't really paid that much attention. I think the other interesting point to note is we've noticed this rotation from growth to value this year. And telcos are very, very much in the value camp. If you look at this chart, this quadrant, the left axis is basically the score on sentiment, and the bottom axis is the score on momentum. So a momentum score is how well the stocks are doing, and the sentiment is how positive people are. So telcos are literally as far down on the bottom left as you can find them. It's that red circle. So this is as contrarian as it gets. And I think in the sort of coming weeks, we'll probably explore some of the telco ideas in a bit more detail, but this sort of sets the stage for that narrative. I'm happy to take any more questions. Let me just quickly see, some have come in. Okay, there's a question on a previous forum topic, and this is on Xiaopeng. It's saying Xiaopeng had a drastic pullback yesterday. This seems to be par for course as the great rotation continues. Okay, it seems that the investment horizon for Xiaopeng should be at least a year. An investor buying now should be prepared to stomach volatility. Any comment on this? Well, I think we totally agree. I think the electric vehicle market hasn't even really taken off yet. It's the beginning. So if you do want this exposure, I mean, that's a personal consideration. But if you do, certainly, be prepared for much more volatility, and be prepared to buy and hold these things for a fairly long period of time. And actually, several of the catalysts that we discussed last week are actually multi-year in nature, and certainly not short-term horizon. And I think maybe I'll make another comment here. Smartkarma as a whole focuses on investing and not trading. These are slightly longer-term bets driven by research as opposed to sort of short-term price moves. Let me see if there's any other question. Okay, so we've got a question on Rex, which is how is the debt burden for Rex?
Rex has no debt, so they have net cash. Actually, they have about $40 million in net cash. There's no debt.
And cool. So, and then if they're making about 240-ish million of profit potentially, then that's a really chunky amount of cash hitting the balance sheet.
Yeah, so that will be from their normal operations now in Oman, and then you will have the one-off sales in Norway from these. I think they have 11, optional fields where they have minority owner. So that's where they also, if they are able to monetize that could be worth anywhere between 40 and 90 million. And just this Shrek field could be worth $25 million US dollars. So that's quite substantial. And if that comes back, I think the smartest thing for them to do would be to buy back their own stock. And the fact that now, since yesterday, they're asking again for authorization next month at an EGM, I think that's probably on top of mind of management as well.
Great. Okay, I've got two more questions here. I think the first question, I'll take it now. This is on Singtel, and the question is, how do you view Singtel now that it has also gained a digital banking license? So let's sort of move away from the digital bank license, and I'll show you one easy way to look at Singtel. So here on Smartkarma, in our tools section, we have a holding company monitor. And a holding company is basically a company that owns a whole bunch of other companies and different assets. So when you look at the valuation, you add up the underlying valuations of the different things it owns. And Singtel is probably one of the largest holding companies in this part of the world. It has stakes in an Indian telco called Bharti. It has stakes in Indonesia. It has Optus in Australia, and so on. So what our holding company tool does is it computes a real-time valuation or fair value for such a company. So I'm just going to load it. This takes a little bit of time to load the first time because it's downloading, many years of data points. So while it loads, I'll just explain what we're about to see. Basically, these stocks either trade at a premium or a discount to the fair value. And oftentimes they trade at that discount to that fair value or net asset value, as we call it. And what we can track using this tool is how much of a discount or premium it's trading on now. So let me just stretch this out. Bear with me. Okay. So you'll notice that Singtel, if we go back to 2016, 2017, so about 5 years ago, used to trade at a 30% discount to its NAV. That has actually widened a lot here. And but some of these things are a derating as well. So telcos have derated across the region and this discount has widened. But if you look at the band within which this trades, it's actually sitting right in the middle, like it's sort of mean. Typically when share prices fall to below the lower band, that's a good time to be looking at owning some of these names. And when we go towards the top end of the band, it's a good time to be maybe booking out. But with Singtel, now coming to the question around banking license. Well, first of all, it's not going to move the needle for this company at all in the short term. And the second thing also, my personal opinion here is that, Singapore is not underbanked. It's, if anything, it's overbanked. And, with more new banks coming in, I don't see them being extremely profitable ventures anytime soon. If anything, this would be a bit of a cash drain. The company will be allocating a lot of capital and, you might have a very distracted board as a result. But again, this is one view. This is not necessarily a view on the ability for Singtel to do capital management and return value to investors. As I mentioned, we'll be looking at single stock ideas around telcos in the coming forums. But yeah, good question. I thought, I'll at least show you this tool and give you a little flavor. I think another question, it refers to previous ideas. It's a question on, do you have any updates on Times Neighborhood? So Times Neighborhood is a property management service company. And what's happened over the last few months is basically a big sort of bifurcation. Some of the stocks have stayed very expensive, others have become cheaper, and now we're seeing consolidation. So in the last couple of months, we've seen Country Garden buy out one of the smaller peers, and Times Neighborhood could potentially be an acquisition candidate too. One important thing with Times is that they do not have a parent that can inject a lot of assets into them. So they have to go out to the market to buy assets. In comparison, some of the other smaller names do have parentage and hence are a little bit better in terms of acquiring new service contracts. One more question on Rex. Oh, actually, plenty of questions coming on Rex now.
Okay.
First, what does Rex do with its cash? Do they pay it out in dividends or reinvest in their own development?
No, so far they have not. I mean, they have not. Basically, they have continued to reinvest in buying new. So they're also continued. Also earlier this year, they bought some new, minority stakes in new exploration wells in Norway. The interesting thing is in Norway, if you buy these exploration wells, 78% of your exploration spend is tax deductible. And so it's very lucrative for people to actually, as junior explorers, to go in there and try to find oil. But then the game that Rex has so far played is never actually bring it to development and just sell their minority stakes to the partners once they find something. So that's basically what they're doing. But now, given the age of the principals, it comes a point to, yes, are they going to start to pay big dividends? Because of course they own half of the company. So my thinking is that you first buy back a lot of stock, so you increase your stake, and then start to pay back dividends. So I think that could come and should come going forward.
Right. Also, does Rex have high CapEx, R&D, and other non-operating costs, these expenses seem to have been omitted from your calculations.
No, they were not. They were put in. They were. I estimate them to be about $16 a barrel. So that was the overall estimate that I put on it, and which is, from talking to management, I think that's a ballpark figure that should be correct.
Cool. I'll potentially now use this last question as the last one for today. Any updates on PC Partners, Nick?
PC Partner, yeah, it's been a wild ride. They actually have results, I think, today coming out. I think they have a board meeting today or tomorrow. So we'll get an update. The market remains super tight. Chip shortages everywhere in the world are super tight. They will have, there have been some Taiwanese competitors who reported this week. They're also, talking about a good outlook. I still think PC Partner has probably more to go. I don't know where I don't even know where we finished today because I was out. But it has been super volatile. We hit 6 at one point. Now we're back to 3.8. I think fair value in my last update was about 4.5. So I think, yeah, it will be very interesting to see the results come out today or tomorrow, and so we can get another update for how management sees the business evolving. But I still think, overall, the whole Bitcoin, the whole chip shortage, the continued gaming demand, they're closely linked to NVIDIA, but also AMD. It bodes well for them. And I think, results should, maybe not in the first half, but at least in the second half, should look way, way better. And this company is still super cheap. I mean, it's like really, really low multiples. It never traded at a high multiple. So in my calculations, I'm never assuming it trade at any high multiple. If any kind of the narrative would change and people will start seeing this as a Bitcoin proxy, then the sky's the limit. But for now, I think I would hold, and you will also should get a very good dividend, unless my analysis is wrong. I think management hasn't had the management is a big owner as well, so they would also like to reinstate the dividends. And in the past, they've always been very generous with their shareholders.
I think I'll sort of also briefly draw your attention to Nick's comment from 17th of Feb, very sort of actionable actually, where it sort of I think the stock had hit close to $6, and you were sort of advising a partial exit as sort of a prudent strategy. Yeah. Fantastic. With that, thank you very much for everyone's participation and good questions, and speak next week.
Thank you.
Bye-bye.